Very good afternoon and welcome to today's session of the virtual coaching classes. So yesterday we had completed our discussion on the linear inequalities, and today we shall be starting with a new chapter, and that is the time value of money. Now before that, I was going through some of your queries, like some of you were unable to find the link for the CA Students Journal. The link is this: just go to www.icaI.org/post slash students-journal. Okay, so you will get the February 2021 journal, www.icaI.org/post/students-journal. Okay. Similarly, you can go to the institute site and definitely download the referencer for foundation. Then some of you were asking questions regarding whether it is enough if we practice the MTP, RTP, and the additional question bank and the exercises. Yes, it will be more or less adequate for the exam if you are able to cover the exercises, the additional question bank. Please go through all the solved problems in every chapter, and definitely the MTP and the revisional test paper will provide you additional questions for practice, and it will be more in that way you can prepare yourself for success in a better manner, and it will definitely serve to make you more comfortable and confident to face the exams. Now, linear inequalities we have done, and once again, we saw that it is basically dependent on three parameters, three parts to it. The first was that you have to find out from the given conditions, framing the equation is the first part. The second part is you have to also look into the constraints which are given and optimize the situation, optimize the problem. And the third is you need to graphically present your solution, the feasible region. Fine. So today we are starting with the time value of money, and this is a very, very important part of your curriculum because number of questions are going to come from time value of money. In fact, in mathematics portion, the maximum number of questions from any chapter, if it comes, and that chapter definitely is time value of money. So the maximum number of questions from one chapter in the mathematics portion comes from the time value of money. So we have 3 days to cover this chapter. Today being the first day, we shall look into and understand the basic overview of what is time value of money. Then the concept of interest. Now you see, whenever you are putting your money in a bank account, you are earning interest. When you take a loan from a bank, you have to pay interest. So we shall see what is interest and what is the difference between simple interest and compound interest. So we will look into the definition and the basic difference between simple interest and compound interest. And we will also look into what is the effective rate of interest, right? The effective rate of interest. And we will do numericals on these areas, definitely from the question paper, from the exercises. And tomorrow we will start with annuity, which is day 2, annuity, concept of present value, future value, and we will compute returns, return calculation. The third day will be the last session on the time value of money, and on that day we propose to complete how to apply present value for leasing decisions, bond valuation, capital expenditure, and the concept of compounded annual growth rate, which is CAG1, and take up the questions from the CA exam and the MTPs, right? So that is how we will proceed. And we first start with this chapter today we are doing is the simple chapter, and you will find that it is a conceptual chapter. You don't have to memorize many formula, just 1 or 2 formula, and definitely good number of questions, as I said, will come from the time value of money, making it the most from the marks perspective, from the weightage perspective. I guess this is one of the most important chapters in the syllabus for mathematics. Now, the first point we take up is page 4.2 of the study material. You can refer to the study material, page 4.2. Now, what do you mean by time value of money? Now, you see, if I pay, say I'm putting some money in a bank account. So let me assume that I'm putting rupees 1,000 in a bank account, in my bank account today, right? This year. So you know that the bank pays you a particular interest. Now, why is interest paid? Bank account, and maybe it is for 1 year, and during that 1 year, the bank is having that money. And the bank, what will the bank do with the money? The bank will lend it to others and they will earn interest, right? So they must also pay me, they must compensate me, and that is why interest is paid. So if you assume that the rate of interest is 5%, so 5% is the interest rate, okay? So if 5% is the interest rate, and I'm keeping the money for 1 year, then what will be the interest on rupees 1,000? 5% means, you know, 5 by 100. So I will write 5 by 100 into how much? Into 1,000, because I'm putting 1,000 rupees. So how much is that? That is 50 rupees. So I will get interest of 50 rupees at the end of the year. So I can say that the money today, I'm putting in 1,000 rupees today. Okay. Today, the value I'm putting is 1,000. And after 1 year, say in 2022, February 2022, after 1 year, this amount becomes 1050, because the total amount I get is 1,000 plus the 50 rupees as interest. So you see that due to the passage of time, right, this 1 year has passed away, and therefore the 1,000 rupees with which I started this transaction is now worth 1,050. So the money which you receive today is always better. If I give you two options, that, well, you will get 1,000 rupees today, and the other option, so option number one is that, say, 5,000 rupees. Let me increase the amount, 5,000 rupees today. And I give you another option that if I give this 5,000 rupees to you in the month of July 21, which one will you accept? Getting 5,000 rupees today or getting 5,000 rupees in the month of July? See, in both the cases, the amount involved is 5,000. Okay? But then, what will be the impact? If you get 5,000 rupees today, February, you can definitely invest the money. If you get 5,000 rupees today, you can put the money somewhere and you will earn some interest. So the money which you receive today is more valuable. It is more valuable than the money which you receive at a future point. For example, here we have taken July 2021. So the time value of money states that the earlier you receive money, the better it is, because you can reinvest the money and earn interest. Okay, so this is basically the concept of the time value of money. Now you know that why the bank pays you interest. When you put your money in a bank, or if you put your money in a debenture, in a share, you are learning about shares. You have in accounts, accounting for shares, issue of shares, debentures, preference shares. So when you invest your money in a debenture or in a bond, you get interest. Why? Because of another concept. So first concept was the time value of money. And the other concept which we need to slowly understand is there is a term which you find in economics also, and the time and the term is known as opportunity cost. Okay, opportunity cost. Now, What do you mean by opportunity cost? So if I'm putting the money in a bank, opportunity cost means the money I could have invested somewhere else. And there I could have definitely earned if I put the money in business. Say its amount is 10,000 rupees. I'm putting this money in a bank. I will get interest. Why? Because the bank knows that I have an opportunity cost, which means that if I do not put the money in the bank, I could have used the money for running my business. And there I might have earned some profit. This 10,000 rupees is an investment. So you see, the basic objective of business is to generate profit, is to generate returns, is to earn some return on your investment. So this 10,000 rupees, if I had used it for any other opportunity, I could have earned some money. So the interest is nothing but a compensation for the opportunity cost which I have. Right? So this is the concept of opportunity cost. And you can now understand the time value of money, which says that the money you receive today is better than receiving the same amount of money in future, because if you get the money today, you can start investing the money. And the moment you invest the money in your business or in a bank or in a financial institution or in shares, you will earn some return. Okay? So this is the time value of money. Right, I am giving another example, another practical example of time value of money. Right, so you will understand how precious time is, and the entire chapter on time value of money, present value. And let me tell you, friends, that this chapter has a huge practical significance, practical application in financial management. From IPCC onwards, you'll be learning about financial management. There you will find that the entire concept of present value is based on the time value of money, and you will have number of applications of time value of money. But the basic concept is same, that if I get money today, it is much better than getting the money tomorrow, because I can invest the money in some business, in some opportunity, and any opportunity means I will earn some return, I will generate a profit, okay, I will get back something extra. Why do we do business? A business person, a businessman invests money, materials, manpower, resources, and puts his efforts and time for what? To generate return, to generate profit, to generate something extra, something more than what he started with. Right? So therefore, that is the opportunity cost. Opportunity cost, say I'm giving an example. Say, for example, you are a practicing chartered accountant. So like I am a practicing chartered accountant, right? So I have my own practice, I have my firm, but then I have an opportunity cost. If I had been working in a company, I would have got certain salary, right? So I must generate more income from my practice, and this I should do so that I can earn more than my opportunity cost. Otherwise, there is no sense doing in practice. So if somebody is earning, say, 50,000 rupees per month in practice, and he could have earned 80,000 per month in a job, J for job, then you can see there's no point being in practice, because your opportunity cost is more. You could have earned 80,000 rupees in a job. But if you could have earned 80,000 rupees per month in a job, but in practice, when you have started your own firm, if you are earning 1,20,000 per month, then definitely it is a better option. You are earning more than the opportunity cost. Okay, so interest is paid because the person, here the bank, where the money is kept, the bank knows that I could have earned some return. I could have generated something extra. I could have earned some profit if I had invested the money in some business. If I had lent it to, say, for example, my neighbor wants the money for some days, definitely I will tell him that, okay, I'll pay you this amount. I'll pay you 1,000 rupees, but then you must pay me something back. So use the money for 3 months, use the money for 1 year, but pay me back something more. Maybe give me another 100 rupees more. So when you return, you don't return 1,000 rupees, but you return 1,100 rupees. Right? So this opportunity cost will be there everywhere. Right? So therefore, these two concepts, the time value of money and the opportunity cost, you have to remember. Next is, there is one more concept which you have to understand, and that is something you have already learned possibly in economics, right? And that is inflation, right? So here you see this chapter is something where you will get certain common points, right? In mathematics and also in economics. So we looked at the time value of money, then the opportunity cost, OC in short. I'm writing OC in short, right? So you can say that, yes, some responses are coming. So let me see the responses. Yes. Opportunity cost, yes, Supradha Bargavi from Chennai. Yes, opportunity cost definitely is the cost of the next alternative, which is foregone. The return which you could have earned if you had done something alternate, right? So you see, a person is nowadays, you see so many young people going for startup business, right? So many of them are leaving their jobs. Say somebody, Mr. X was earning, say, 1 lakh rupees per month in a job in Bangalore or in Chennai or in Hyderabad or in Delhi, wherever. He leaves that and he goes for a startup. Okay, maybe the startup is in the field of artificial intelligence, e-commerce, whatever. Now he knows that my opportunity cost is 1 lakh, and if I want to go for my startup, I must earn something more than 1 lakh. Otherwise, there is no point doing this startup, because I can always, if I earn from my startup, if I earn 50,000 per month, then definitely it is not economically viable. It is not a wise decision, because my opportunity cost is 1 lakh. That means if I take the other alternative, if I go back to my job, I can earn 1 lakh rupees per month. So whatever type of activity he is doing, he must earn something more than his opportunity cost, right? So this is an important, you can say it is an important concept. Yes, Pooja, opportunity cost you have written is also known as alternate cost. Yes, it is the cost of the alternate opportunity, right? That is why it is called opportunity cost. So if I'm putting money in a bank, I definitely get some return. I will get some interest. You see, when you invest in shares, you get a return, and that is called dividend. You know, it is called a dividend. Okay. When you invest in a bond or a debenture, I think you have learned what is debenture or a bond. Debenture means it is like a debt instrument. Okay. Like a company issues shares, they also issue debentures. You can buy the debenture at 1,000 rupees or 100 rupees as per the face value. The debenture will have a life of 5 years or 7 years or 8 years. Every year, the company will pay you an interest. So in case of bond, we call it interest. In case of shares, we call it dividend, right? Similarly, when you are putting your money in a fixed deposit in a bank, okay, you get interest. Right? So every business will have some return. You have a house, you are putting it for rent, you will get a rental income. So there is always a return which you get. Okay? It can be of different names, Sometimes you see royalty income, license fees. These are different type of returns which businesses generate. Right? But this is because of the fact that every business has an alternate use. Right? So it is basically, yes, Neha, opportunity cost is the next best cost, or you can say that it is the cost of the foregone opportunity. Like here for this startup, this young man is maybe earning X amount per month, but he has an opportunity cost of 1 lakh. He has given up that opportunity. He has left his job. He has surrendered that opportunity. He has sacrificed that opportunity. So he must know that, yes, if I had continued in my job, I would have got 1 lakh rupees per month. And that is the cost which I have. So I must earn more than that. Okay. So this is the basic concept of opportunity cost. Now we will see what is meant by inflation, right? Inflation. Then you will understand how interest and inflation are linked. Okay. Now, friends, recently you must have seen during the period of the pandemic, and you must have seen the budget which was placed on the 1st of February by the Honorable Finance Minister Nirmala Sitharaman, Madam. So in the last 1 year, what has happened is the inflation has gone up. Now, what is inflation? This is there in the study material also, and it is part of this chapter on time value of money. Inflation means the general increase in the price of commodities, right? So if you see the price increases, this is, say, for example, time, and this is the price of certain commodities. Let us take the most common commodity which everyone consumes if you have a two-wheeler, if you have a four-wheeler, and that is petrol. Petrol or diesel, right? That is fuel. You must have seen for the last few days, whether you are from Delhi or you are from Chennai, you are from Pune, or you are from Vijayawada, or you are from Lucknow, right? You must have seen that the price of petrol and the fuel, diesel and petrol prices are rising. It has touched almost 90 rupees per liter. So this is a general increase in the price. And many people are saying that will the price of petrol lead towards a century, right? They're asking, that means will it touch 100 rupees per liter? It's a big problem for the common man. This is first. So the price of fuel has increased. If the price of fuel increases, you can understand the transport cost will increase. Because without fuel, you cannot drive lorries and trucks and buses. If the transport cost increases, the price of vegetables and fruits will also increase. Agro commodities will increase because the fruits and vegetables and the crops are coming by trucks and lorries. I hope you're following. So this will lead to a general increase in the price. And when this happens, this is called inflation, right? Inflation, if you inflate a balloon, what does it mean? It becomes bigger, right? You are inflating a balloon, right? Inflate means you are, say, when you see your bicycle tire, right? You are pumping air into it. It gets inflated. Inflated means to increase in size. So here also, when the price increases over a period of time, this is called inflation. And you must be knowing about one particular term, which is called CPI, which means the Consumer Price Index. Okay, it means the Consumer Price Index. So many of you have seen that the Consumer Price Index is increasing for the last few months due to the pandemic because of two reasons. First is there was an increase in the fuel price, the petrol price, and if petrol price increases, every other commodity price will also increase. So this is called inflation, and this is what you need to understand about inflation. Now, the point is, as price increases, what happens to the purchasing power? What happens to the purchasing power of a common citizen? Purchasing power. Okay, that means, will you be able to purchase the same quantity? Say, for example, if your income is same, if your salary is same, and the price of commodities, food items, okay, fuel, right? Then say whatever we need in our daily life, if the price increases, whatever we eat, whatever we use, what will happen? If my salary is same, will I be able to purchase the same quantity? No. So my purchasing power will fall. So this is an important relation. As inflation increases, as inflation goes up, right? As inflation increases, the purchasing power, PP, will fall. So please note this point: as inflation goes up, as the general price of commodities increases, automatically the purchasing power will reduce. People cannot buy so much. You have seen during the lockdown and after the lockdown, as per the World Bank report, 1 person out of every 5 persons lost their job. Many companies were unable to continue. There was a fall in demand, right? So what happens? The supply also went down because companies were unable to produce anything. So you must have noted there was an increase in price. Even though people cannot pay, the price went up rising, right? So it led to a fall in the purchasing power. So this is there in page 4.2. These are important concepts which you need to be very clear about so that you can understand the next area, and that is the next part, which is the interest, simple interest, compound interest, and effective rate of interest. Okay, so you see interest is paid. Why? Because of many reasons. Reason number one, because there is something called time value of money. If I use your money for some time, I must give you something back. Why? Because if you had not given the money to me, you could have used the money as per your own interest, as per your own liking, as per your own preference. You could have lent that money to your friend. You could have lent that money to your, say, to your relative, or you could have bought something with the money. But I'm asking for the money from you. So I must give you something back because I'm using the money for some time. And this is the time value of money. So I must pay you something. Now it can be interest, it can be dividend, whatever name. Right? Second is, every bank, every financial institution will pay you interest. Why? Because they know that you have an opportunity cost. You could have used the money for an alternative purpose. You have foregone that opportunity. You have sacrificed that opportunity. You have given up that opportunity, and you have put your money in the bank. You have invested the money in the financial institution. So they are bound to pay you something. They are bound to compensate you for the money and for the time. So this is the opportunity cost concept. Third is, definitely we must understand that if inflation, now I'll just give another example, and I'm sure you will understand that simple example and you will be able to give the right answer. Now, if inflation rate is 4%, that means, say for example, the price of particular commodity last year was 100 rupees, and this year, so this was in 2020, and the same commodity is available at 104 rupees in 2021. So we can say there is a rise in price and 4%. Okay. So if the inflation rate is 4%, what should be, and say for example, if you earn an interest from your bank deposit at 3%, is it a good idea? So if inflation rate is 4% and the interest rate is 3%, is it a good idea? Is it an intelligent option? Okay, Vivek has given us the update. Vivek from Maharashtra. Yes, petrol price has reached 100 rupees. Yes, definitely. Manpreet from Delhi. Yes. What causes inflation? See, it can be due to supply, demand. If the supply of a particular commodity is less, right, people will be willing to pay more for it. So this will increase inflation. If people have too much of money in their pocket, what will happen? You will go on buying, buying, buying. The more you buy, the rate will increase, the price will increase, right? Money supply. So what the Reserve Bank of India does is to control the money circulation, because if the money circulation is very high and people are earning a lot, what will happen? They will try to consume more. So the more you consume, the more will be the rise in prices, and that is inflation. Okay, Yes, Kumar Vikram from Bangalore. In the exam, yes, these reasons may not come, but then you can get a theory question that inflation is dash dash, and they can give you four options. Opportunity cost. What is opportunity cost? They may give you four options, and you have to pick the right option. So you may get questions on the theoretical part as well, right? So CPI, Shweta, CPI meaning is Consumer Price Index, right? So when the entire commodity which a consumer buys, see, the common man, people like all of us, what do we buy every day? We buy food, we buy clothing, articles for clothing, we consume services, not just products, but services, right? You are going by Uber, you are taking an Ola car, maybe you are not taking your dad's car or your family car, but you're going by a taxi or by a cab or by an auto rickshaw. So that is a service you are taking. So if the fuel price goes up, definitely taxi fare will also go up. The transport cost will go up, right? So the vegetable which you are getting in the local market, right, or the grain, say whatever you eat as your staple food, which you buy in the local market, it will increase. The price will increase because the transportation cost has gone up because of the rise in the fuel cost. So this ultimately increases the cost of each and every commodity, and this general rise in the price is known as inflation. Okay, and of course, there is a relation between inflation and interest. The Reserve Bank of India adjusts the interest rate so that inflation can be controlled, right? So right now, for the last few years, if you see in the budget, the last few months, if you see inflation touched almost 9%, that means a commodity, general price level has increased by 9% from 2019 till 2020. And this is a fact which was presented by the Honorable Finance Minister on 1st of February while she was speaking in the budget session, when she was unfurling, when she was giving the proposals in her budget speech. She talked about the inflation. So inflation reached a very high level, almost 9-10%. Then it came down in the month of December, January, right? So inflation has also got a certain relation with interest. Okay, fine. So you can see that inflation is caused by several factors. And as inflation goes up, the purchasing power of a person will definitely fall. If the income is same, the person will not be able to consume so much. The person will not be able to purchase so much. So the purchasing power will fall. Right. Now we go to interest, principal, and amount. Okay. So we have talked about the time value of money, opportunity cost, inflation. Okay. We have also seen why interest is paid or received. Okay. Now we will look at some mathematical relation, which you all know, and that is, today is a very light and easy session. You will, most of it will be revision. The first part of the time value of money is almost known to all of you. There's nothing much new to learn, just a recap, a quick revision. Now, you all know that if I put, say, 2,000 rupees in a bank, okay, in my account, right, I will get some interest. So 2,000 rupees is called the principal. This you all know. Say the bank is offering an interest of 6% for 1 year, and this is written as per annum. Per annum. Okay. In short, it is written as PA. So the bank is offering an interest of 6% per annum for 1 year. So in 1 year's time, what will be the interest which I will earn? So 6% means how much? 6 by 100 into 2,000. So that gives me 120 rupees. So this is the interest for which I'm earning. So at the end of 1 year, how much money do I have now? I will be having 2,000 plus 120. This 2,000 is the principal and this 120 is the interest. Together, it becomes 2,120, and this is known as the accumulated amount. The accumulated amount. So I'm writing accumulated amount. Okay. So the first relation which you need to note down, you all know this, but still, since we have it in the study material, it's there in the syllabus. I am explaining that, but this is known to all of you. Amount A is equal to principal plus interest. Okay, this is the first relation, and you may get simple problems on this type of relation, mathematical relation. So amount is equal to principal plus interest. Okay, fine. I think so far you are following and understanding. And please remember that per annum, you will get this term per annum in your questions. And per annum means it is for 1 year, right? Fine. Now let us go into the next topic, next concept, and that is, let us do a simple problem and see. I will take page number 4.5, example 1 of the study material, page 4.5. So I'm just rubbing this part, and let us see and solve the examples, and then we will see some of the questions from the exercise. So example 1, page 4.5. So page 4.5, example number 1. Right. How much interest will be earned on 2,000 rupees at 6% interest for 2 years? Okay. So the principal P is 2,000 rupees. The interest rate, I, small I means the interest rate. Okay. The interest rate is 6% per annum. So I'm writing 6% per annum. Okay. And the time T is equal to 2 years. So we have to find out the interest, the total interest which you will receive in 2 years' time. Very easy. This is high school mathematics. So you can understand interest I is equal to principal P into the interest rate, this I into the time, PIT. Here the principal is how much? 2,000 multiplied by interest rate. Interest rate is 6%, which means 6% means either you write 6 by 100 or 0.06. So let me write 6 by 100. So 2000 into 6 by 100, 2000 into 6 by 100 multiplied by 2. Time is 2 years. Okay, so I write 2. So that gives me how much? 100, and this cancels. 20 into 6, 120 into 2, 240. So I'm getting interest equal to 240. Fine. So this is the first example. So you see, we note two formula here, which I will write. So we have discussed about time value of money, opportunity cost, interest, and we saw two formula. Formula number 1 is amount is equal to principal plus interest. And the second formula is this one, that the interest itself is equal to principal into interest rate into the time. Okay, this is the first example, and I hope it is clear and you are following, you are understanding. Next is example 2. Okay, page 4. Let me take 4.4. I think example 2. Okay, so this is clear. 2,000 is the principal. Okay, time is 2 years. Interest rate is 6% per annum, which means 6% for 1 year. So the interest, total interest is principal into interest rate into time. 2,000 is the principal. Interest rate is 6 by 100 and the time is 2 years. So it gives me 240. Fine. Now we will take the second example and see whether how we are able to solve it. Now the question says that Sania deposited 50,000 rupees in a bank for 2 years. So the deposit is 50,000 rupees in the bank. Okay, so this is the principal, 50,000 rupees, and the time is 2 years. Okay, The interest rate, let us see the interest rate given. Interest rate is 5.5%. So interest rate I is given by 5.5%. So I'm writing 5.5%. Okay, perfect. We have to find out the total interest that she will be getting, she will be earning. Right. So once again, please see that the interest rate yes. So the interest rate, okay, the interest rate here is 5.5%, and the principal amount is 50,000. The time is 2 years. So what will you do? What will you do? The interest formula is I equal to principal into interest rate into time. So the principal amount is 50,000. I will write 50,000 here. The interest rate is 5.5. Okay. So I will write 5.5, but then this is upon 100. Okay. So 5.5 by 100. Okay. Or you can put it in this way, 0.055. Okay. So let me write 0.055 here. 0.055. Fine. Into the time is 2 years, 2. So let me just use my calculator and find out. Just a sec. You can also do it with me and see. 50,000 into 0.055 into 2. Okay, this gives me 5,500. So the interest is 5,500. Okay, this is as simple as something which you did in high school, right? So just these two formula you need to remember. Amount is equal to principal and interest, and the interest is principal into interest rate into time. So in this case, you see, what will be the amount? What will be the accumulated balance? Now, accumulated balance A is equal to principal plus interest. Here, the principal is 50,000, right? And the interest is 5,500. So I will add 5,500. So the balance at the end of the year, at the end of 2 years, is going to be 55,500. Fine, right? Now there is one small concept here. So we have talked about interest and inflation and time value of money. Now, if the bank tells you that okay, you are putting 10,000 rupees in our account. Okay, you say you are opening a fixed deposit. You know what is a fixed deposit? Fixed deposit. Fixed deposit means you are putting some money in an account in the bank in your name, right? And maybe it is for 2 years or 3 years or 5 years or 10 years, and the bank will pay you an interest on that at a fixed rate. That is why it is called a fixed deposit. Now, say you are opening a fixed deposit of 10,000 rupees or 1 lakh rupees, say, and the bank tells you that instead of paying interest, okay, we will not pay you interest. You put 10,000 rupees in our account, right? We will not pay you any interest, but we will give you concession, right? When you come to the bank for the next time, and if you ask for a loan, we will give you a concession. Will you be happy with it? Number one. Second scenario is, instead of getting a cash discount, if somebody tells you that I will not give you any cash deduction, but next time when you buy some commodity or anything from us, we will give you a voucher, gift voucher. Do you really want that type of gift voucher? No. We want interest in the form of cash. We want deduction in the form of cash. We want immediate returns in the form of cash. Why? Because there is a concept called liquidity preference. Okay, there is a concept which is known as liquidity preference. I'm writing it here. Liquidity preference. Liquidity preference. What does liquidity mean? Liquidity means any asset which is in liquid form. That means which is realizable in the form of money, in the form of cash. Now, if I ask you two simple questions, you know, in the balance sheet, you have current assets, you have fixed assets in the balance sheet. I think you are learning about balance sheet. You already know about the components of a balance sheet. Now, if I ask you between cash in hand and stock, which is inventory, which one is more liquid? Which one is more liquid, cash in hand or the stock which you have, closing stock? Which one is more liquid, cash in hand or stock? Okay, which one would you suggest? Cash in hand is more liquid or stock is more liquid? So if you think, you will understand cash in hand is more liquid, because cash in hand means it is in the form of cash, currency. But stock means it is my closing stock. It is not in a liquid condition. It has to be sold. Then only the buyer will pay me money, which will be in cash, in the form of cash or in the form of check or in the form of demand draft, whatever. So you see, everybody wants liquid money, everybody wants cash. So therefore, liquidity preference, because of the rule of liquidity preference, that is one of the reasons why the bank or any financial institution will pay you interest, which is in the form of monetary terms. Here you saw that the bank is offering 5.5% simple interest, and as a result of which, the total amount, the accumulated balance at the end of 2 years comes to 5,500 plus 50,000, which is 55,500. Okay. So liquidity preference means that you need to have, every person wants returns in liquid form. Okay. So definitely when somebody is looking for money, say somebody is in a real need of money, there's a medical emergency. He asks for 4 lakhs. If I tell him that I don't have 4 lakhs, you take my car, sell it in the market, will he be happy? No, he needs money in cash. Somebody wants to start his business. He approaches me for a loan. He approaches me for a financial support. I tell him that, how much do you want? He tells me that I want 10 lakh rupees. I tell him that, no, I don't have money of 10 lakhs, but I have a property, a land, which is 10 lakh rupees value. You take the land. Will he be happy with that? No, he needs money to start his business. He needs money to buy the raw materials. He needs money to buy plant and machinery. What will he do with the land which I give him? What will he do with the car which I give him? Are you getting the point? So it is all about liquidity, and that is why it is called liquidity preference. Every person needs liquidity, cash in hand, and therefore this is one of the reasons why interest and any type of return, dividend, interest, royalty, franchise income, everything, rent, is always paid in cash, is always paid through bank transfer. Okay, so this is another concept which you have to keep in mind. Yes, cash in hand. Yes, Jasmine from Bhubaneswar, cash in hand. Absolutely. Archana, thank you. Zifa, thank you. Veni has said stock. Veni, no, I'm sorry. Stock will not be liquid because stock has to be converted to cash. Okay, so always remember, the order of liquidity will be like this. The most liquid is cash in hand because you have it in your pocket. Cash in hand, pocket. Next is cash in bank because it is not with you, it is in the bank. Then little bit less liquid is debtors, sundry debtors, who is supposed to pay you. And from debtors again you have stock. So if I write here, you will understand stock, debtors, cash in bank, and cash in hand. Cash in hand is the most liquid, number 1. Cash in bank is not that liquid. So number 2. Debtors is number 3, 4th is stock. So as I move up, it becomes less liquid. As I move down, it becomes more liquid. Liquidity preference increases as I move down. Okay? Stock is the least liquid. cash in hand is the most liquid because you have the currency in your hand. Okay, you have the money in your hand, in your pocket, you have the check. But if the money is in the bank, it is not that liquid. Similarly, if the debtor, if the money, you have sold your goods, but the money is supposed to come from the debtor, the money is supposed to come from the customer. That means you have not yet got the money, but you will get the money. Now, there's a difference between getting the money and will get the money. There's a difference between if I say I have passed CA foundation and if I say I will pass CA foundation, there is a difference. So if I say I have 10,000 rupees in my pocket, which the customer has just given to me, this is something, I have it, it's an asset. But if I say I will get it after 2 months, now there may be a question, I may get it, I may not get it, I may get the full payment, I may not get the full payment. So both are not the same. Okay, so please note that as we go down, the liquidity increases. As we go up, the liquidity decreases. This is the liquidity preference theory. Great, very good. Many of you have written, Manpreet, yes, good. Absolutely, Manpreet. That is why cash, it comes under, cash is there in current asset, cash in hand, cash at bank, sundry debtors and inventory both are in current asset because it is expected that it will be realized in the within 12 months. So it is there in the current asset part. Okay, yeah, Prashant, yes. Now the question is, yes, I was giving the example of land. But then if the person wants to start a small grocery shop with that money, what will he do with the land? He needs money in cash. He needs money in liquid form. Are you getting the point? Every business does not require a land. Maybe the land which I have, maybe it is worth 10 lakhs, but it is 50 kilometers away. The person, say my neighbor, right, he wants to come out with a small grocery shop, or he wants to start a small, say, e-commerce business in this particular locality, but the land which I have is 50 kilometers away. Yeah, that is valued at 10 lakhs. But what will he do with that land? He has to find a customer, he has to sell it, then he will get the money, right? I hope you understand that land is not liquid. In fact, as you go in the balance sheet, the more you go towards the topmost portion, you will find that the balance sheet is so scientific. As you move up, you find that the items are less liquid. Fixed asset, less liquid. Cash in hand, most liquid. So as you move down from the top, land and building, plant and machinery, furniture and fixture, vehicle, these are fixed asset, non-current asset. They are not liquid. But as you move down, current assets, stock is liquid, little bit partially liquid, debtors, more liquid, cash in bank, more liquid, and the most liquid is cash in hand. Right, good. So good to see that many of you. Yeah, Ritik has said, let me see the points coming in. Yeah, what about check? Okay. Suprabha, yes, check. Yeah, check definitely is not as liquid as cash. The check may bounce. So definitely in terms of liquidity, definitely it is not at par with cash. Okay. Liquidity means easy to convert money. Absolutely. So the way, the sooner you are having cash, you see, you will read about cash flow statement. Every company has to prepare profit and loss account, balance sheet, and cash flow statement. Cash flow statement talks about, cash flow statement discloses the amount of cash and cash equivalent which the company has at the end of the year. Now, the cash equivalents can be in the form of other, maybe in the form of demand draft, maybe in the form of bank overdraft, which the company might be enjoying. So it may not be in real currency terms. It may be in other types of cash equivalent nature. Right. Okay. Yes. Okay, now let's go on with the examples, and we will take the third example. And this time it is, you have to find out the accumulated balance or the amount. This is example 3, page 4.5 from the study material. And let us see. You see, the basic concepts are the 4 concepts. So what is inflation? Interest, you can understand, liquidity preference, and opportunity cost. Right. So the example says that Sachin deposited 1 lakh rupees in his bank for 2 years at the rate of 6%. So the principal is 1 lakh and the time is 2 years. T is time and the interest rate I is 6%. 6% means 0.06. So I will write 0.06. Now, the question is, how much will he earn at the end? That means what will be the final value of the deposit? So today he is depositing how much? 1 lakh rupees for a period of 2 years. The interest rate is 6% per annum. So what will be the amount which gets accumulated after 2 years? We know that amount is equal to principal plus interest, and interest is equal to the principal multiplied by the interest rate to the time. So principal is 1 lakh. I will put 1 lakh here. Interest rate is 6%, and that means 0.06, 0.06, and the time is given 2 years. So again, let me calculate and see how much we are getting. So 1 lakh multiplied by 0.06 into 2. So I'm getting 12,000 as the interest. So this interest I have got 12,000. Okay. The principal we know is 1 lakh. So the amount is 1,12,000. Fine. So these are easier problems. Right. Now we will move on to the next question. Here we have to find the interest rate. So up till now we were finding the interest amount. Now you have to find the interest rate. Okay. Okay. Now what they're saying is very interesting. They are saying that principal is 1,000. Okay. Fine. The amount, that means the accumulated balance is, the amount is how much? 1050. And the time is 6 months. So what is the interest rate? Let's try and find it. Let's see if anyone else can do it. Many of you are practicing the problems with me. So let us see how to solve this problem. So here you see the time is 6 months. 6 months means half of an year. Okay. So it is 0.5 year. Okay. Half 0.5. So we know we have to find interest I. Now from here you can see the amount is 1050 and the principal is 1000. Okay, the principal is 1000 and the amount is 1050. Okay, so you know the formula, amount is equal to principal plus interest. Or I can write interest is equal to amount minus principal. Okay, it follows. Amount is 1050 minus principal is 1000. So interest is 50 rupees. The interest amount is 50 rupees, but we have to find the rate of interest. Okay, so we use this formula, I equal to P into I into T, where I is the total interest amount, P is the principal, I is the rate of interest, and T is the time. Let me see if I can work it out and we can get the answer. So interest we know is P into I into T. Here, interest is how much? P into I into T, let me try. P is 1000. Into I, we don't know I, and the T is 0.5. This is equal to 50, this 50. So I will be equal to how much? 50 divided by 0.5 into 1000. Okay, so how much is, let me check whether we are getting any answer. So 50 divided by 1000 divided by 0.5. So it comes to 10%. Just check, it comes to 0.1, which is nothing but 10%. I is coming to 0.1. 0.1 means 10%, right? So the answer is 10%. So please see this solution. Here we have got the principal amount, the accumulated balance is given. From there, we can just subtract and we can get the principal, the interest, which is 50 rupees. The time duration is given half a year, 6 months, so half. And we first get the interest 50, and then we apply the formula I is equal to principal into interest rate into time. By following that formula, we achieve I is 0.1. That means it is 10%. Okay. Okay, now, yes, Kumar Vikram has said that if PA is not mentioned, now if it is mentioned as 6%, 10%, 9%, in majority of the cases, the problem will mention the word per annum or per year. Even if you don't get anything, say it is written that interest rate is 7%. So you can assume it that 7% means per year and not per month. It is 7% per year. Okay, but in most of the cases, you will find that the word per annum or the words per year will be clearly mentioned so that you don't get confused. Okay, good. So many of you have got 10%. Excellent. Okay. Zifa, Gunjan, Swati, Karishma, yes. M. Arun Kumar, Khushi, Pooja, Devesh, excellent, good. Okay, now we will take the next one and let us see if we can. So now we will work on another interesting question. So this time it was the interest rate. Now we will find the time. Okay, so let us see the next question and try to solve the next one. And let's see what figures are given. So the question is from page 4.5. Rahul invested 70,000 in a bank. So invested 70,000. So I go on writing the value. Principal is 70,000. This is the money which is invested in the bank. The rate of interest is given I is 6.5%, which means 0.065. Okay. It is given 6.5% per annum simple interest. So you can see per annum is mentioned. Now he received the amount, accumulated balance is 85,925 at the end of the term. So it could be 2 years, 3 years, 4 years, whatever. Now we have to find out what is the time. Okay, so we have to find what is the time here. So what to do? So you can see that the interest, the principal is 70,000 and the amount is 85,925. Okay, so it's very simple. First, you find out the total interest. The total interest means it is the amount minus principal. Okay, no doubts about it. You are clear? So this is 70,000 is the principal and 85,925 is the amount. So I will subtract 85,925 minus 70,000. This gives me 15,925. This is the interest which Rahul has earned as per this problem. Now this is the interest I. We know that I is equal to P into I into T, where P is the principal, I is the interest rate, T is the time. Okay. So let me put P rate 0.065. Time we don't know. This is T, time. We don't know that. We have to find time. But this is equal to the interest, and the interest is 15,925. So you have 70,000 into 0.065 into T is equal to 15,925. So can we solve for T and see what it gets, what number it reaches? So let me do it. 15,925 divided by 70,000 divided by 0.065. So that gives me 3.5. That means the time is 3.5, which means it is 3.5 years. Okay, 3.5 years. Okay, good. Right. Now let us take the next concept of compound interest. So we have done all types of problems on simple interest, and now it's time to take, yes, 3.5. Many of you have got it. M. Arun Kumar, Nivedita Garg, Pooja, then Neha, Devesh, B. R. Jayashri, Khushi, good. Priyanshi, Karishma, great, very good. Excellent. Now we go to compound interest, and I will just write here compound interest so that we know that it is a term which we are going to learn together. I'll rub it up, and now we will see compound interest. This is a wonderful concept, and this is something you should never forget. So long as you are in your career as a chartered accountant, you should never forget. As a CA student, you should never forget for the remaining part of your life. Now, the compound interest. Now, you see, simple interest means that I put 1,000 rupees in the bank. Okay, I put 1,000 rupees in the bank, and say they pay me 10% interest. So 10% per annum. So at the end of 1 year, I will get how much? I will get 100 rupees. Why? Because 10 by 100 into 1,000. So I get 100 rupees interest. So principal is 1,000, and the interest I get is 100 rupees. Fine. This is simple interest. Then what is compound interest? Compound interest means PI. Compound interest means interest on interest. Okay, interest on interest. What does it mean? So if I say that I am earning in a bank, the bank is paying me 10% interest, not on a simple interest basis, but on a compound interest basis. What will be the difference? Here, what am I getting? My principal is 1,000. Okay, let me draw. This is simple interest, and this is compound interest. Please see carefully. The principal in both the cases is 1,000. 1,000. Fine. Year 1, year 2, year 3, year 4, year 5. We will take 5 years and calculate. Fine. 1,000 is the interest, is the principal amount with which I start. 10% is the interest rate on simple interest basis. Compound interest rate is also 10%. Let us first see what will happen here. The interest at the end of 1 year will be 100 rupees. Okay, so I will get how much at the end of 1 year? I will get 1,100. In the second year, again, interest will be on 1,000 rupees. Interest will be calculated on 1,000 rupees. I will get 100 rupees interest. Third year also 100 rupees interest. Fourth year also 100 rupees interest. Fifth year also 100 rupees interest. Because the interest of 10% is calculated on the principal, original principal of 1,000. But in case of compound interest, there's a small difference. What will happen in compound interest is that you start with a principal of 1,000 rupees, 10% interest is added, so you get 100 rupees interest. And now the principal P1, the new principal, becomes 1,100. Okay. Now please see, the second year interest will be calculated on 1,100 and not on 1,000. So 1,100, 10% of 1,100 is 110. So the second year principal, if you see, will be 1,100 plus 110, that is 1,210. Next again, 10% will be calculated on 1,210. Here 10% on 1,100. So 1,210, 10% of that means around 121. So your next principal will become the way in which principal is changing, you see, is becoming 1331. Now 10% will be calculated on 1331, so it's roughly 133. So the new principal again becomes 1464. Again, last 10% on 1464, so that becomes somewhere around 146. So you get 1610. So this is how compound interest works. So interest plus the original principal plus interest that is added, the interest is worked on the new principal. Again, interest is added, you get a new principal. Again, interest is added, you get a new principal. Right? This is why it is called compounding, compound interest. Now, definitely, if I ask you which one is better for you, which one would you prefer? Simple interest or compound interest? Let us see how much money you can get in simple interest. In simple interest, the principal remains 1,000 and the interest every year you get 100 rupees. But please see here, in the first year, both are getting 100 rupees. But in the second year, simple interest you get 100, but compound interest you get 110. Third year, simple interest you get 100 rupees. Compound interest you are getting 121. Fourth year, next year, simple interest 100 rupees, compound interest 133. Next year, simple interest 100, compound interest 146. So which one is preferable if you want to invest money? Which one would you prefer? Let me see if anyone is given the interest. Okay. So definitely, I'm sure you will prefer compound interest, because here the money which you are getting is much more, because the interest is getting calculated on the revised principal. Okay, so this is the basic concept of compound interest. Shomo, let me see, Shomo Gupta from Bilaspur. You did not get 3.5. Let me again go to that question. Why didn't you get 3.5? Yeah, 70,000. Quickly, Shomo, you do with me. Right, 70,000. The others can just see the calculation. Shomo, 70,000 was the principal and the amount was 85,925. So you subtract, you get the interest. Total interest is 15,925. And that will be equal to the principal amount into interest rate into time. Interest rate is given 6.5%, which means 0.065. So just multiply 70,000 into 0.065 into the time t should give you 15,925. This is the equation, Shomo. So Soumya, please check the equation and do with me, and I'm sure you will get the answer. Okay. So you will get t equal to 3.5. Right. So we are getting number of answers from Daman Kaur, Ritik Singh, Gopika, Rohan Jain, Jitendra. Yes, definitely. Jasmine Das, Karishma, Bishwabandhu Mohanty, Devesh, Khushi. Yes. Compound interest follows the same concept, yes, as the WDV. Yes, Khushi Datta. Khushi, you are correct. So it follows the concept of WDV, written down value. Very similar to written down value. We will do it. You see, straight line method of depreciation is like simple interest. See, it's like that. Original value of the machine, depreciation on the same original value. This is straight line method, SLM. This is WDV, written down value, 1,100, 1,100. Written down value is 1,100. I calculate depreciation 10%. See, it's the same concept. Depreciation of 10% or interest of 10% is same. The concept is same. The same working out. Okay. So I think compound interest is always preferable. Okay. Now there's a lovely question. Mahadevan also has said we prefer compound interest. Manpreet from New Delhi has also said compound interest. Shaurojit Bonik from Kolkata has also said compound interest. Fine. But then there is a beautiful question from Supratha. Why people invest in simple interest when compound interest is more? Thank you for the question. Now I have a very humble question to all of you. Simple question. This is good for us. Everyone is correct. Each of you, you are correct in saying that compound interest is always preferable. Very good. But your gain, if you get compound interest, you will gain. You will be in a better position. You will earn more money. But do you think banks are so foolish that they will pay you compound interest? Then banks will have to pay more money. So bank always pays you by simple interest. Most of the investments which you have, the return is always on simple interest. But there are 2-3 investments where you can earn compound interest. Only 2 or 3 areas. Otherwise, everywhere the interest you get in a loan, in a savings bank, the interest which you get in a fixed deposit, the interest you earn in post offices, in most of the cases, it will be simple interest. But there are some compounding cases also. So the question was beautiful from coming from Supradha, that why people invest in simple interest, because they don't get the option of compound interest. There are only 3 options where you can earn in compound interest. I will write the option. Okay, this will be practical. You can also discuss it with your parents, because your parents invest the money. Public Provident Fund, PPF, you get compound interest. This Public Provident Fund is run by the Government of India, and the account can be opened in any branch of State Bank of India or Punjab National Bank, Bank of Baroda, okay, Indian Overseas Bank, many banks, ICICI Bank, you can open PPF. You can just Google it out. The return is compound interest. So right now the interest rate is 7.1%, but that is on compound interest. So the money which you keep in the PPF account, okay, it will increase like this and not like this. So PPF is an example. The second example is, you might be knowing that many people invest in mutual funds. Mutual fund. And there is a term which is called SIP, Systematic Investment Plan. What people do is, they every month, right, they put 500 rupees in an account. You must have seen the mutual fund advertisements which come up in TV, in different channels in television, right? So they always say that mutual fund is the best way to save. What they do every month, they pay 500 rupees. They put it in an account, but the interest which they earn will be on compound basis. Okay, so there are only very few investments like SIP, like PPF, which is where the returns are on compound interest basis. Else, in most of the cases, almost in a clear majority of the cases, banks and any financial institutions will pay you the interest on simple interest basis. Okay, now we will see the formula for compound interest. A very simple formula which you need to remember, and we will do the numericals on compound interest after that. Okay, and the last part after compound interest we shall take up is the effective rate of interest. Okay, now the compound interest formula is very simple. What happens is, in case of simple interest, the amount is principal plus interest. Okay, and in case of compound interest, so I'm writing in case of compound interest, the formula is like this. The amount is equal to the principal into 1 plus I to the power n. Okay, where I is the interest rate and n is the number of conversion period. The number of conversion periods. Okay, now sometimes you can have yearly compounding, okay, which means the money which you earn, the interest which you earn in 1 year, that money is added with the original principal to form the new principal. This is yearly compounding. Sometimes the compounding can be done every 4 months. That means, every 3 months. That means every quarter. There are 4 quarters in a year. The compounding can take place in half year, every 6 months. So say I have 1,000 rupees. Okay, I put 1,000 rupees at the rate of 6%. Clear? This is compound interest, CI. So what I do is in the first, say the compounding is done in every 6 months. 6 months compounding. Okay. So what I do is, what I will do, the calculation will be like this, that 1,000 rupees, 6%. So the interest is 6 by 100 into 1,000 into 6 months. 6 months means 6 by 12. So I will be getting 10, 6, 2. Okay. And 2, 3. So I get 300 rupees as interest. 300 rupees as interest. Okay. Just I'm taking 6% I'm assuming. That means it is, no, 30 rupees. Not 300, 30 rupees as interest, 30. So the interest for 6 months I'm getting is 30 rupees. The principal is 1,000. The interest for first 6 months is 30 rupees. So the new principal becomes 1,000 plus 30, which is 1,030. Now for the remaining 6 months, this 1,030 will be the principal, and on this, again, 6% interest will be calculated for half a year. So the interest which I will earn is 1,030 into 6 by 100 into 6 by 12, whatever amount it comes. So this is the concept of compounding in every 6 months. Okay. Now there is one more question from Vikas. In which bank they prefer SI? All banks prefer simple interest, all banks. Okay. Then Anjani Kumar Singh from Chhattisgarh, is PPF a safe way to invest? Yes, Public Provident Fund is a safe way to invest. I was writing because of 3 reasons. You get high return because of compound interest. Number 2, the risk is 0 because it is controlled by the government. And number 3 is you get tax benefits also under Section 80C. It's a very safe mode of investing. Then thank you, Manpreet, for your comments that you are following and you are getting the interest. Okay, Akshara from Chennai. One interesting point, is investing in mutual fund safe? Okay, investing in mutual fund is subject to market risk. Please read the offer document before investing. This is what they tell you. Yes, mutual fund investing is not absolutely safe. There are risks, especially during COVID. Many mutual funds could not deliver the returns they promised to deliver, right? And definitely mutual funds are of different types. I will not take time in discussing that. There are debt-oriented mutual funds, equity-oriented mutual funds. Yes, there are some safe mutual funds where the investment is done in bond and debentures. So they are quite safe, but the returns are less. Always remember, as the risk goes up, the return goes up. So if you want more return, you have to take more risk. That is the fundamental, I will say the fundamental concept of financial management. Okay. Right. Let me see. Okay. Sneha Garg from Gujarat. Why in mutual fund ad it is said that it has risks? So read all deal related offer documents carefully. Yes, because mutual fund has a lot of risks. Mutual fund means what? I am giving 500 rupees, you are giving 300 rupees, say Sneha is giving 300, Anchal is giving 200, say Akshara is giving 200, then Supradha is giving 100, Vikas is giving 500. So they are pulling the money and then they are investing the money in different shares, debentures, bonds, gold, real estate. You're getting the point. But if it is during the pandemic, if the inflation is very high, the purchasing power has fallen, economy is not doing well, how will they earn? During the pandemic, just imagine last year what happened. Companies had to shut down their operations. No revenue, so no profit. If no profit, then no dividend. If I don't earn money, how can I pay the dividend to you? If I don't earn money, how can I pay the interest? So the mutual funds could not do well, and they sometimes, what happened was even the principal amount, Now you invest the principal amount to earn a return, but in some cases, some mutual funds could not even guarantee the principal amount. So you are an investor, you put 50,000 rupees in the mutual fund with the expectation that in 1 year, you will get 10,000 rupees extra. You will get a return of 10,000 rupees. So the total amount will become 60,000, 50 and 10. This was your expectation. But if the economy does not do well, if the markets are flat, if the markets fall flat, what will happen? The mutual fund could not generate the return. So instead of giving you 60,000, it has happened in some cases that people lost part of their principal. So they ended up getting 30,000. They started with 50,000. They are getting back 30,000. Just imagine. This has happened. So mutual funds definitely are subject to market risks, and definitely you need to read the offer document. Good. That very interesting point has come. Okay, now regarding N, there is N. Hitesh is share market is good. Yes, share market is good provided you know the rules of how to invest. Right. Good. Index fund is right choice in mutual fund. Shubham, oh, index fund, you are very advanced. Index fund replicates the movement of NSE, Nifty and Bombay Stock Exchange. Yes, index fund is a good way to invest because the returns will be approximately close to what the Sensex gives you. But then there are a number of factors to be seen in case of index funds. For example, you need to see the tracking error, right? You need to see the tracking error. You need to see the expense ratio. Different factors are there. Okay. Good. Fine. So now we will take some problems and you will see that the calculations are also very interesting and simple. And we are having some wonderful questions coming from all of you. And I'm really enjoying in giving the answers and discussing on this very interesting chapter. So you can see that so many are coming, which means you can understand that the chapter is so practical. It's so practical. So let us talk about the numerical, and the numerical which we will take first. The numerical we are going to take first is a very simple question, and the question is, we will try to take page 4.12, and this is a question on compound interest. Page 4.12. A question on compound interest. Okay, so let us just go to this question, page 4.12, and we will deal with this question on compound interest. So 2,000 rupees, the question says that 2,000 rupees is invested. 2,000 rupees is invested at the annual rate of 10%. So 2,000 rupees invested at the annual rate of 10%. Now, the rate of interest is 10%. Please note, but this is definitely on compound interest basis, right? Because we are working on compound interest. Okay. So when we have compound interest, the question is, what is the amount after 2 years? What will be the amount after 2 years when the compounding is done annually? First one is annual compounding. The second is semi-annual. The third is quarterly. And the fourth is monthly. Okay. Now, there is a question coming from one of our friends. Yeah, semi-annual. Vinay, semi-annual means 6 months. Isha from Lansdowne. Okay, which one is safe? Mutual fund or equity? Mutual fund is safer than equity because the equity markets, the returns are high, but the risk is very high, my dear friend. So mutual fund is safer because you have a fund manager. Okay. Hitesh Prabhu, do share market safe for investments? Yes, again, share market is safe when you know the rules and when you know the strategies for investing. Okay. Why PPF gives compound interest? Pooja, PPF gives compound interest to attract people's investment, right? This is a technique used by the government so that people put their money in a safe mode. PPF is absolutely safe, number one. And number two, my dear friend, is that in case of PPF, you also get tax deduction. So this is a way to attract money from the so that people can also invest. And you know that for income tax purpose also, you need to invest so that you get tax deduction. So that is why government has made PPF with giving compound interest, right? Okay, fine. Prashant Kunal from Bihar. What will happen if n is 24? Well, you will not get that kind of problem, because n24 means you have to find 1 plus I to the power n, 1 plus I to the power 24. Definitely, you will not get those problems. Okay, let us do these questions. Beautiful interaction from all of you. Thanks for that. So 2,000 rupees invested for at 10% compound interest. So I'm writing TI, and the amount after 2 years we have to find out annually. First, we do the annual one. Okay, so annual means, please see, annual means what? Year, per year, per annum. Okay, it means per year. So the formula is A equal to P into 1 plus I to the power n. Very simple formula, where P is the principal, I is the interest rate, n is the number of years or number of conversion period. Initially, we are doing this one, annual. Annual means what? So annual means n is equal to what? N is equal to 1. Okay. If the amount is 2, now we have to find out after 2 years, right? So the conversion period is 1. Compounding is done at the end of 1 year, right? So if it is for 2 years, then how many compounding will take place? 2 times. So here n will be 2. Compounding is done at the end of 1 year. That means the interest is calculated at the end of 1 year. Then it is added with the original principal. Then the next year's interest is calculated, right? So here the compounding will be done at the end of 1 year, but the conversion period is 2, because it is basically for 2 years. So now we will see the result. Now interest rate we know is 10%, which means it is 0.1. I'm sorry, 0.1. Just writing it, 0.1. So the amount after 2 years, if you follow compound interest at the rate of 10% per annum, okay, for 2 years, will be P is 2000 into 1 plus I is 0.1 to the power 2. N is 2 because we have 2 types compounding, 2 times, because compounding is done at the end of 1 year and the time period is 2 years. So I'm getting 2000 into 1.1 to the power 2, that is 2000 into 1.21. Let me just find out using the calculator, and please do with me to see what do we get. 2000 into 1.21, 2420. I'm getting the answer 2420. Okay, so this is the solution to the first problem, where we are going for annual compounding. Okay, annual compounding. So this is done. I'm cutting it out. Now we have semi-annual compounding. This little bit of intelligence will be required, and we will do it. So the formula remains the same, but there will be a small change in our approach, in our assumption. Okay, so P remains as it is. I, there will be a change in I, because the interest was 10% per annum, but now the compounding is done semi-annually. So if 10% interest is paid for 12 months, 1 year, then what will be the interest for 6 months? So 10% is paid for 12 months, or you can call it 1 year. Then for half a year, what will be the interest rate? So how much will be the interest rate for half year? Because the compounding is done semi-annually. That means every 6 months, right? So if I ask you that, okay, I have, say, somebody tells me that, yes, I can take his motorcycle on rent. Okay, now the rent for 2 days, or the rent for full day, 1 day, 1 full day is 100 rupees, 100 rupees. Okay, then what will be the rent for half of the day? If the rent of the motorcycle for one full day is 100 rupees, then what will be the rent for half of the day? How much? 50 rupees, I think. Same thing. So here, if the interest is 10% for the full year, then what will be the interest? What is going to be the interest for half of the year, 6 months? It will be 5%, right? This is the change you need to be very careful. 5% means 0.05. Number one, adjustment number one. The second point is half year, okay? And the total number of the time period is 2 years. That means the compounding n will become 4. Half year, 1 year, again half year and half year. So 4 times. Okay, half into 4 gives you 2. So half into 4 gives you 2. So that means the formula will be 70. This we have 2000 here. 2000. Principal is 2000 into 1 plus I. I will become 0.05 to the power 4. This we have to calculate and see what happens. 1.05 to the power 4. So this will come to 2000. Let me just calculate and see. 1.05 to the power 4. So 1.05 into, carry on multiplying. So 1.2155 multiplied by 2000. I am getting 2431. So the answer is 2431. Okay, this is for the half yearly semi-annual compounding. We have done this as well. Now we have the third question, which is the month, I think the quarterly compounding. Okay, compounding. Okay. Many questions are coming. Anchal, thank you. You from Dehradun. She is saying that I have become your financial consultant. Thank you. Okay. Then, yeah, good. We are discussing about investment management, and that is something you will learn in your IPCC and final as well. Simran is asking the question, why interest is 0.1? Because you see 10% was the interest. So 10% means what? 10 by 100, that is 0.1. Right. Yeah, 2431. Jitendra has got 2431. Pooja has also got 2431. Fine. So when we just follow what I'm saying, you will understand. So I is the interest. Okay. And here we have seen that the interest rate is 10%, which is 0.1. Right. But if it is calculated on a half yearly basis, then 10% will become 5%. I was giving the example that somebody tells me that, okay, I can take his bicycle for rent. I have to pay him 100 rupees for full day. So if I want the bicycle only for 12 hours, half a day, how much will I pay? I will not pay 100 rupees. I will pay 50% because half, I will pay 50 rupees. Similarly, if the interest is 10% and if your duration is 6 months, so the interest becomes how much? It becomes 5% for 6 months, accordingly 0.05 and 0.05 and to the power 4 because the number of compounding is 4 times. Right. Now we will take the quarterly case, and this one will be definitely to the power 8. But don't worry, I don't think such problems will come in the exam. If it comes in the exam, they will give you the value. So you don't have to worry on that. So now we are going for the quarterly compounding. Right. Quarterly compounding means every quarter means what? Every 3 months. There are 4 quarters in a year. Okay. So 3 months. So if the interest is 10% for full year, quarter means 1/4 of a year. Okay. 3 months, 1/4 of a year. So if the interest is 10% for the full year, I'm writing full year, then for the quarter of the year, it will be 10 by 4. That is 2.25%. 2.25 means this is equal to 0.0225. This is 2.5. I'm sorry. Yeah, 2.5%. So this will be 0.25. 0.025. This will be the interest rate. Okay, and N will be how much? N will be You have 2 years, and the compounding is done every 3 months, 4 times in a year. So in 2 years, it will be 4 into 2, 8 times. So n is 8. So therefore, the formula will be like this: 2000 into 1 plus I. I is 0.025, 0.025 to the power 8. Okay, this will come to around 2436.80. Right. So normally what will happen when you get these type of problems to the power 8, to the power 10, so this entire value will be given. In most of the cases in the exam, the value will be given. Right. Okay. Now we take up the next question, page 4.14. This is also a very, very important question for your exams, page 4.14, and a very appropriate type of questions, okay, for the exam. Page 4.14, and the question goes like this: what annual rate of interest compounded annually doubles the investment in 7 years? Very important question. Let's try to understand the question. You have to find out the annual rate of interest. Compounding is done annually. So let me write the facts. Compounding is done annually. Very good. We don't know the rate of interest. So I is question mark. We don't know the rate of interest, I. We know that the investment doubles it in 7 years. So 100 rupees becomes 200 rupees. That is, it doubles in 7 years. Now, in the problem, if you see the problem in the study material, it is given 2 to the power 1 by 7. This is given 1.104090. This is given in the problem. So now let us apply the formula, right? The question is, the principal amount becomes double in 7 years. If the compounding is done every year, okay, once a year, then what is the interest rate? A very, very relevant question for the exam. So that means the principal P becomes 2P, double of P. Now, what I will write is, we know that the amount is equal to principal into 1 plus I to the power n. This is something we know. But now the amount becomes double. So P becomes double, it becomes 2P. Okay? So what I will write is, instead of writing amount A, now I will write 2P is equal to P into 1 plus I to the power n. We don't know I. As n is given, right? N is given, n is 7. N is 7 because we have 7 years, it doubles in 7 years, and the compounding is done every year. So 7 divided by 1 is 7. If the duration is 7 years, but if the compounding is done every 6 months, then n will be how much? N will be 14. 7 into 2. Okay, so since it is annual compounding and the duration is 7 years, so therefore the value of n, that is the conversion period, will be 7. So we have this formula. So let me simplify this. 2P is equal to P into 1 plus I to the power 7. Okay. So can I strike P and P? P and P gone, cancelled out. So what I'm having now is 1 plus I to the power 7 is equal to 2. 1 plus I to the power 7 is equal to 2. Please see. Now see, it is given, the problem you see is given, the value is given, 2 to the power 1 by 7 is given. So if 1 plus I to the power 7 is 2, please apply your knowledge of indices. A to the power m into a to the power n is equal to a to the power m plus n. Similarly, 1 plus I to the power 7 is equal to 2, so I can write it as 1 plus I is equal to 2 to the power 1 by 7. And 2 to the power 1 by 7, thankfully, is given in the problem, and the value is 1.104090. So 1 plus I is equal to 1.104090. So I comes to 0.104090, that is 10.41%. Please see this carefully, very important question. So it is given in the problem that a particular sum of money doubles itself in 7 years. Now here, let me give you, since many of you are asking so interesting questions on investment and which one is safe, and right, whether mutual fund is good, whether share market is good. Okay. Yeah, Hitesh, the value of 2 to the power 1 by 7 will always be given in the exam. Don't worry, you don't have to worry on that. This type of difficult calculations you don't have to do, and if such a question comes, then definitely it will be given in the exam. Yeah, Karishma, I'm repeating the question once again. Jitendra has got it right. Okay. So the money doubles itself in 7 years. Before that, let me give you a quick extra tip. This is not in the syllabus. Something extra, just for 1 minute. Let's have some fun with maths. Now, just remember, there is something called rule of 72. Rule of 72. Rule of 72 means that if, see, everybody asks that if I want to invest in this mutual fund, if I want to invest in this bond, in debenture, in how many years I can double my money? How quickly can I double my money? 1,000 rupees will become 2,000 rupees in how many years? This rule is called rule of 72. If you know the interest rate, say it is 12%, simple interest, then the period to make it double will be very simple. Just divide 72 by 12. 6 years will be the answer. If somebody tells you that I am earning 8% on 8% simple interest, okay, 8% simple interest, say on a particular investment, in how many years I can double my investment? So rule of 72, 72 divided by 8, 9 years. The answer is 9 years. Just remember that rule of 72. Similarly, there is a rule of 114, 114, that is called 112, which talks about 3, how many years it will take to triple your money. And there is a rule 144, which says how many years it will take to make your money 4 times. Okay, fine. So this question definitely is important for the exam. And you see here, we were trying to find out original money is becoming double in 7 years, but the compounding is done every year. So amount becomes double. I start with 500 rupees, I get 1,000 rupees. Karishma, I hope you're following. I'm explaining it because you requested me to explain it once again. Please see, the amount becomes 2 times of the principal, right? The principal becomes 2p. So the formula we know is amount is equal to principal multiplied by 1 plus I to the power n. Okay, this amount is nothing but 2p. So I'm substituting a by 2p. I'm getting 2p equal to p into 1 plus I to the power 7, because the duration is 7. Conversion period is 7. So p and p is getting cancelled. So I'm getting 1 plus I to the power 7 is equal to 2, this 2. But now comes the application of indices, which you have learned already. Okay, so you know that if, let me write it here. Let me write it in this side. If x to the power k is equal to p, then x is equal to p to the power 1 by k. As simple as that. So if 1 plus I to the power 7 is 2, then 1 plus I will be 2 to the power 1 by 7. 2 to the power 1 by 7, the value is given clearly in the problem. So I put the value here, and by deducting 1, I get I 10.41%. Karishma, I think this is clear now. Just go through the video once again, and definitely it will help you. So please remember, as I said, the rule of 72, right? The rule of 144. So these are shortcuts and tricks by which you can quickly find out in how many years the given amount of money will double itself, triple itself, and It will become 4 times, quadruple. Okay. Then there's a question from Shivangi. Will we have mutual fund in our syllabus in future? Yeah, absolutely. We are doing the foundation. This chapter, I'm sure later on when you read about mutual fund in CA final, you will remember these days when we are discussing about time value of money, and definitely you will definitely remember that we discussed about the time value of money and we discussed about risk and return, right? Okay, now let us see, let us go into the next point, and that is, let me take the next question. This is from page 4.15, and this is also an important question for our exams. 16,000 rupees invested at 10%. Let me just write the problem and see. So 16%, 16,000 rupees invested, rupees 16,000 invested at 10% per annum, and this is on compound interest, but it is semi-annually compounded. That means it is compounded in every 6 months. So please remember that it is compounded every 6 months, and you have to, the problem says that the amount 16,000, this amount becomes 18,522. You have to find the time period. So let us just review the problem and see how we can solve it. Okay, just a sec. So the given problem is 16,000 is the principal, right? 16,000 is the principal, and we have, it becomes 18,522. The compounding is done, of course, it's a compound interest problem. The compounding is done every 6 months, and the interest rate is 10%. Okay, so just let us try and see what will happen. Okay, and just remember the rule which I said, the rule of 72, rule of 114, and rule of 144. So the time taking to double your money, just divide the interest rate, 72 by the interest rate, 114 for three times, and 144 for 4 times. Okay. Now let us try and solve this question. So here you see the principal P is 16,000. Fine. This is clear. The amount A becomes 18,522. And we know the formula. The formula we know, A is equal to P into 1 plus I to the power N. So we can write that P is how much? 16,000. So I will write 16,000 into 1 plus I. I is 10%. I is 10%. It is compounded in every 6 months. So the interest rate for 6 months will not be 10%. It will be 5%. So I will take 0.05. This is the important adjustment we are doing. This to the power N will give you 18,522. Okay. So the interest rate we are taking at 5%. Now, if you work it out, let's see what happens. We are getting from here, this into this is this. So 1 plus 0.05 to the power N. This is 18,522 by 16,000. And this comes to, okay, this is coming to 1.157625. 7625. 1 plus 0.05 to the power N comes to this, right? So from this, you can find out that 1.157625, if I just find the cube root, let me see, what do I get? So just finding the cube root, 1.0. Okay, 157625, fine. So if you see 1.157625 is basically the cube of 1.0 1.05 whole cube. Okay, so the cube root is 1.05. So you can easily understand 1 plus 0.05 means 1.05 to the power n. This is coming to 1.05 to the power 3, because 1.05 to the power 3 is 1.157625. So from here, the base is same. And if the left hand side is equal to the right hand side, then n has to be equal to 3. That means the conversion period basically is 3, right? That means the time period is 3, not 3 years, but 3 conversion period. The conversion compounding period is 6 months. That means 3 into 6 months, that is 1.5 years. 1.5 years is the answer for this problem. And this is how we achieve the answer, by getting the value. And this is how we solve this problem, 1.5 years. Okay. Now we go to the last point for today's discussion, that is the effective rate of interest. Just a sec, effective rate of interest. And with this, we will close the chapter today, the first part. Now, effective rate of interest means what? There's a small formula, and before that, we will just understand. Okay, now I was giving an example of effective rate of interest. So the effective rate of interest actually means, say there is a compounding done every 6 months. Okay, and I start with a amount, with a principal of say 10,000 rupees, and I start with 10,000 rupees, and the interest rate is 6% compounding in 6 months. Okay, so first I will find out the interest on 10,000 rupees for 6 months, at 6%. So what will be the interest? 6%, 6 by 100 into 10,000 into 6 months by 12. So this gives me how much? 100. So 6 and 2, 2 and 3. So I'm getting 300 rupees as my interest for the first 6 months. For the first 6 months. Okay. Now this is compounding. That means now the principal, the new principal, becomes 10,000 plus 300. That is 10,300. This is the new principal. Okay, clear? Okay, now the interest for the next 6 months will be calculated on 10,300. Okay, so the interest for the second half of the year. First half is done. The first half is already done. Now the second half. So 10,300 into 6%, that is 6 by 100 into 6 by 12. That is, it is also for 6 months. So if you calculate it, it comes to, let me check, 309. Okay, so 309. So the total interest I'm earning is, the total interest which I'm earning is 300 rupees for the first half and 309 rupees for the second half of the year. So 609 is the total interest I have earned. Right, now definitely this is more than what I could have earned if I had the money in simple interest terms. So I've earned more. And the effective rate of interest you can find out by a very simple formula. So we just write that formula. We have dealt with only 2 basic formula today, and that is enough for today. The first formula is that amount is equal to 1 plus principal into 1 plus I to the power n. Now we see the last formula. The effective rate of interest is given by the formula 1 plus I to the power n minus 1. A very simple formula. 1 plus I to the power n minus 1, where I is what? I is the interest rate and n is the conversion period, number of conversion period. Okay, so now let us see page 4.19 of the study material, 4.19, and we will try and do one problem. The problem is we have to find the amount of compound interest and effective rate of interest if an amount of 20,000 rupees is deposited in a bank for 1 year at the rate of 8% per annum, compounded semi-annually, right? So let me write the facts of the problem. The principal is 20,000. Fine. Interest rate, is it given? Interest rate is given 8% per annum. Compounding semi-annually, that means every 6 months. So compounding is 6 months. Okay, fine. So we have to find the effective rate of interest. Compound interest, you can easily find the effective rate of interest formula. So ERI, effective rate of interest, short form ERI. ERI is given by 1 plus I to the power n minus 1. So this is 1 plus I. I is 8%. Okay, but 8% is for the full year. Here, the compounding is done every 6 months. So 8% is for the full year. So for half a year, it will be 4%. 8 divided by 2. So 4% means 0.04. So I will write 1 plus 0.04 to the power n minus 1. Now here it is given that the compounding is done semi-annually, right? And it is kept in the bank for 1 year, right? So here n is 2. So n is 2. So 1 plus 0.04 to the power square minus 1. This is equal to 1.04 square minus 1. Let me just use my calculator mobile and check it. Just a second. 1.04 into 1.04 is 1.0816 minus 1. So it gives you 0.0816. This is the interest rate. 0.0816 means what? It is 8.16%. So the effective rate of interest is 8.16%. Okay. Now, okay, Akshara has a good question. Compounding per year is good or compounding per 6 months is good? You tell me. Compounding per 6 months is better because you will get more money. Similarly, compounding in every quarter is even better. The number of conversion period, the more, you can easily understand, the more n increases, as n increases, you are getting the benefit. So quarterly compounding is better than half yearly compounding. Half yearly compounding is better than annual compounding, right? I hope you have followed and you have understood. Good question from you. Okay. Now, effective rate of interest is used, right? Basically for finding out calculations later on when you do calculations on different type of calculations for investments, different type of investments, which investment gives you the right interest rate, the return. So there we use the effective rate of interest to find out the calculation and to find out basically which investment is most effective, which investment is best in terms of returns, right? Aarti, please study. We are going so well and detailed discussions going on. We are covering all the questions, but you must study to understand, right? Please study hard and go through the video once again to understand. And you need to have basic understanding of mathematics, otherwise very difficult, like LCM and all, very difficult to explain. Okay, right. So this is the use of effective rate of interest, and it is basically the the equivalent annual rate of interest, basically, right? So let me take the exercises. Exercise 4B. Let us take number 1. Let us start from the first one and see. Exercise 4B number 1. We'll do few problems and just try to use this formula and see. So we have done two very basic formulas, which is the first one being the amount equal to principal plus interest. The second is amount is equal to principal into 1 plus I to the power n. And the third formula is the effective rate of interest. Now, exercise number 4B, let us do number 1. Principal P is given by 1,000. Okay. Interest rate is given 5% per annum. So interest is 5% per annum. N is 4. That is, the compounding period is 4. So the compound interest is how much? What will be the CI? Compound interest is how much? So we have to put the formula and see. Okay. So the compound interest formula is A is equal to P into 1 plus I to the power N. Here all the values are given, right? All the values are given. So let us try and see how to do it. P is a principal, right? Principal is 1,000. I will write 1,000. 1 plus I. I is given. Is I given? Yes, I is given. I is how much? 5%. But please be little careful here, my dear friends, because I is 5%, but the 5% is for 1 year. Okay. And the conversion is done. The N is equal to 4. So we have to assume the interest 5% divided by 4, and 5 divided by 4 is 1.125. 1.125. Right. So we have to assume the interest is 1.125 to the power 4. N is 4 given. So we are getting, let me just try it out. Again, we have to use the calculator and see what happens. We have to find out the amount and the compound interest. We are first doing the amount. Okay. And then we can subtract the principal to get the compound interest. Let me just work it out. 1.125, 1 plus 1, 1 plus, no, this is 0.125, sorry, this will be 0.125. Yeah. 5 divided by 4. Just a sec. Just 1 minute. 1.25, right? 1.25. So 1.25 means 0.0125. 0.0125. Just make a small correction. So this will be 1,000 into 1 plus 1, 0.0125 to the power 4. That is 1.0125 into 1.0125. You have to multiply 4 times. This is, you get to the power 4 into 1,000 into 1,000. Okay, just try it out and see. Okay, so just try it out. I think we are getting somewhere around 1050.94. I'll just have to check. 1050.94. If this is the amount, then the compound interest will be this minus the principal. This will give you the compound interest. So we have taken the interest is given 5% per annum and the conversion period is 4. So therefore we assume the interest to be 5 divided by 4 because we have 4 conversion periods. Right. Now we take the second question, exercise 4B. Now we'll take number 10, exercise 4B. Number 10, let us see number 10. Okay. Exercise 4B, number 10. This is also an exam, past exam question, and I have selected it for our working. Exercise 4B, number 10. The question says the compound interest on 16,000 rupees. The compound interest on 16,000 rupees for 1.5 years. For 1.5 years. At 10% per annum, at the rate of 10% per annum, okay? Payable half yearly, it is payable half yearly is how much? It is payable half yearly. Half yearly, okay? Half yearly is how much? So compound interest on 16,000 for 1.5 years at 10% per annum compounded half yearly is how much, or payable half yearly is how much? So we can understand here I is equal to 10%, fine, and it is payable half yearly, right? Therefore, we will assume the interest rate will be 0.05, that is 5%, and therefore let us just work out on the compound interest. Compound interest will be, in fact, let us see the amount first. Amount is equal to 16,000 is the principal into 1 plus interest rate 0.05, and since it is payable half yearly and the total duration is 1.5 years, that means n is equal to 3. Half year, half year, half year, 3 times. It becomes equal to 3. So this to the power 3. This gives you the amount, and 16,000 into 1.05 to the power cube. So just let us work it out and see what it leads us to. 1.05 to the power 3. 1.05 into 1.05 into 1.05 into 16,000. So I am getting 18,522. Okay, this is my amount. Okay, but my principal is 16,000. So what is my compound interest? Compound interest will be what? Amount minus principal. Amount is 18,522. Okay, and principal is 16,000. 16,000. So my compound interest is subtraction. It comes to 2,522, and I think the option number B is correct in this problem. Okay, now there is a question on depreciation, very interesting point. Someone, I think one of our friends was asking during the session that, yes, is compound interest similar to written down value? And I was saying yes. So let us see question number 8, exercise 4B, question number 8. The question is, okay, let me take the question here. Okay, there's a question from Harish. Have I invested in any shares? Yes, I've invested, and sometimes gain, sometimes losses, but then mostly it is gains. Okay. Anis, N means the number of years. No, N means the number of compounding periods. Okay. Say if it is given that the time is 3 years. Okay. And the compounding is done in every half year, then N will be 3 into 2, that is 6. Because half year means 2 times compounding in 1 year. And there is 3 years. So 3 into 2, 6. I hope you are now clear. Okay. 2522, yes. Let me just check this. Number 8, we are trying. Okay. Useful life of a machine is estimated to be 10 years and the cost is 10,000. So cost I'm writing is 10,000 and the estimated life of the machine is 10 years. So the life is 10 years, time is 10. Fine. Rate of depreciation is 10%. Okay, so the time is 10 years and the depreciation rate is 10%. Of course, per annum. Okay, so I'm just writing per annum, PA. What is the scrap value at the end of the life? What is the scrap value? This is a lovely question and important for your exam. Definitely intelligent question. So here what we do is, so depreciation is the opposite concept here, because you see here we have been doing compound interest, means interest is added, okay, to the principal. Again, we compute the interest on interest. So we were all adding plus, but here it is minus. It is minus. So you see what happens is the depreciation rate, if you see, is how much? The depreciation rate is 10%. Okay. So from the original fixed asset, 10% is gone. So we are left with 90%. Again, from the 90%, 10% will go. So we are left with 90% of 90, that is 81%. So in this way, it carries on. So we will take, we have to find the scrap value. The useful life is given 10,000 and the time is 10 years. the rate of depreciation is 10%. So if rate of depreciation is 10%, 10% means 0.1. Okay. So the scrap value will go by 90. It is 10% is getting depreciated every year. So we are left with 90%, 90%, and this is the written down value method. Okay. So what we will do is to find the scrap value 10,000 into 1 minus 0.1. 0.1. Okay. And if you see, depreciation rate is coming to, we have to find the scrap value at the end of its life. So the depreciation rate is coming to 10%. So this is 0.1. So basically it is 1 minus 0.1. But then this is at the end of 10 years because we have to find the scrap value at the end of its life, right? So the answer will be that you have to find this to the power 10. So in this way, it will go on, and it will lead to the scrap value, right? So the same formula is used, principal into 1 plus interest to the power n. Here, principal means the original cost of the machine, which is 10,000. Instead of plus, okay, since it's a case of depreciation, this is minus, right? And what we are doing is we are just putting 0.1 because 0.1 is the depreciation rate. The rest remains the same. The same way in which the original principal add interest becomes the accumulated balance, and under compound interest method, the same process is followed, and the same process has to be carried out here. And eventually, you will be, I think, getting the answer of around 3487. This will be the scrap value of the machine. Now we take the last one for the day, question number 14 of exercise 1, exercise 4B, and let us see what it leads us to. Question number 14 of exercise 4B. The compound interest on 4,000 rupees for 6 months. So the principal is 4,000 rupees and the compound interest is for 6 months. We have to find the compound interest for 6 months at 12% per annum. Okay. This is payable quarterly. This is payable quarterly. Okay. So the compound interest we have to find for 6 months, and this will be payable quarterly. So what we will do is, here you can see that interest is how much? Interest is 12% per annum, and we have to find the compound interest for 6 months, and it will be payable quarterly. Right. So here the interest will be 12% for 1 year, but for quarter it will be 1/4, because you know there are 4 quarters in a year. So 12 divided by 4, that is 3%, will be the quarterly interest, right? And 3% means 0.03. This is 0.03. 3% means 0.03. So now what we are doing is, if we get 0.03 as the quarterly interest, now we have to find compound interest for 6 months, right? Which means that we have to find the value of n, and quarter is 0.03. So half year, 6 months means 2 times. 1 quarter into 2 times gives you half a year. So n will be equal to 2. So therefore, the formula to be used is, we have to find the quarterly, this is the compound interest. So the compound interest will be, let us write the principal first, 4,000 into 1 plus 0.03 to the power 2. This will give the principal, sorry, the amount, minus 4,000. Because 4,000 is the principal, which means 4,000, if you take common, you are getting 1 plus 0.03 square minus 1. If I take 4,000 common from both the expression. This means 4,000 into 1.03 square. So let me just work it out and see what it gives us. 1.03 into 1.03. That gives you 1.0609 into 4,000. So I'm getting 4243, right? So the amount is minus 1. So I'm getting 4,000 into this is 4243 minus 4,000. That means the interest is 243. So I'm getting the interest at 243.6. 243.6. This is the compound interest. So here you see the question was initial principal is 4,000 rupees. You have a yearly rate given 12%, but the compounding is done on a quarterly basis. So we find the quarterly interest 12 by 4, which is 3%. And then we have assumed 3% is the interest and the compound interest is for 6 months. So the compounding will be done 2 times because 2 quarters gives you 6 months, right? Right. So 3 months into 3 months, 3 months plus 3 months gives you 6 months. 3 months means 1 quarter. The second quarter, once you add, you get 6 months. So n is 2. So we have put the formula 4,000 into 1 plus 0.03 to the power 2 minus 4,000. So this is the total amount minus the original principal. This total amount comes to 4243. 4243 minus the original principal of 4,000 gives us the compound interest, and the compound interest is 243.6. Right? So, friends, with this, I think we will wind up and we will just check what we have done. So, okay, just one more problem. Let me see if we have any extra problems. Yeah. So just remember the depreciation concept is also very similar to the one we have in compounding. The only difference is in compounding, we add the interest, and in case of depreciation, we deduct the depreciation rate. Okay. Yeah. And 5%. Okay. Right. Question number 1 also, I think you can do in this way. Yeah, 5% interest is given. They have not talked about the compounding. N is 4, so we can directly take as 1,000 is the principal, and the interest is 5%. So we can directly take 1,000 into 1 plus 0.05 to the power 4. N is 4 minus 1,000. So I think that will give us the answer. Right. This is 4B number 1. Fine. Okay, so we have completed the first part of TVM, and friends, we have gone through a number of interesting concepts. We started with some of the concepts of economics, and we discussed about time value of money. What is the opportunity cost? What is inflation? And then we talked about the liquidity preference theory, why interest is paid. And we have seen 3 very simple formulas. One is the amount is equal to principal plus interest. The second is interest is equal to principal into time into interest rate. And the third one we saw was the compound interest formula. We also saw the rule of 72, 114, and 144. And another point, of course, is we have seen the formula for the effective rate of interest. Right. Next day, we will, I think, take up the next portions of the curriculum, and we will discuss about the 2 interesting points, that is present value, and I think we will, from there, we will carry on to the last part of day 3, where we learn about very important concepts, bond valuation. I was discussing about bond today, debenture and bond. We will see the valuation method. And well, Vinay was asking about some tips to read maths. He failed in his maths previous attempt. In 37 marks, only one tip, go through the videos over and over again till you understand, and please practice. I was sharing with you the referencer. Please go through the referencer. The referencer you will find in ICAI.org, where you find the CA Foundation math syllabus. You will find the referencer there. Very, very important problems on time value of money is done there. We will try to take those questions on day 2 and day 3. I have selected 3 of the questions, but please go through each of the questions. They are explained and solved in a very simple manner, and kindly go through the students' newsletter, because not only for mathematics, for other papers also, you will be getting valuable tips. So that will be my advice to Vinay and to all of you. Thanks. Hitesh, you were asking where can we use rule of 72? The rule of 72 is a rule of thumb which is used to just calculate quickly how quickly you can double your money. Rule of 72, 112 or 114 sometimes is used, and 144. They are not exact 100% accurate. They don't give 100% accurate results. But when we compare the returns of two shares, right, which investment doubles the money faster? So we cannot always calculate. We have to do a rough calculation. That is why it's known as the rule of 72, 112 or 114 and 144, which gives us the time period for doubling the money, tripling the money, and quadrupling the money. That is 4 times, right? Thanks a lot. We had good interactions. See you. And I think day after tomorrow, we will take up the second part of time value of money. Till then, thanks, take care, and bye.